So we had one question about the objectives of the competition. Is it equally weighted, or can we have different weights per stock? Let's just make that clear. Each stock has to be 2%. You have to allocate 2% across 50 stocks. There is no deviation from that rule. So you need to target 2% at each rebalancing date. So let's go back to my payout here. We could see I had some rebalancing dates. In this very instance, rebalancing dates are December, January, February, March. So it's only once a month I am rebalancing, and I am always allocating 2%. Okay, here 2%, 2%, 2%. So there is no deviation from that rule. It's only 2%. We have given you examples where weights could deviate, but that's just a generic thing that you could do in a general payout. But for this very competition, it's 2% per stock over 50 stock. So 2% times 50, you are allocated 100%. Obviously, in between each of these dates, the actual weights of your position, of your stock in your portfolio are going to move. They're going to move around. But don't worry about this. Just worry about when you do allocate, when you do rebalance, it's always 2%. Is there an R function to get the inclusion matrix? Yes, there is. Everything that we have available in Python is also available in R. And the beauty is that it is also the same function. So let's take a look at, here we go. I'd like to, here. If I want to start a new console in R, so from R, I'm going to wait for the kernel to launch. You can see maybe I could, the kernel has started. So in R, you load the library with this, okay? So that's the equivalent of import Alphien. And then you are going to use directly the get tickers S&P 500 function. Let's take a subset so that we don't spend too much time loading that. But I'm just going to take the subset of the insurance, and then the difference is the name of the parameter, and that's as XTS to get this, and we're just going to let that run until it's executed. Maybe I could shut here. I'm going to shut that. Just always manage your kernels. That's just an advice in your lab. You see the number of kernels here. There are 3 kernels open. I don't need 3 kernels because I'm just using my notebook here and the console here. But that's the way it's going to run anyway. I invite you to obviously again take a look at this S&P 500. Each time you do that, you're gonna have the 2 versions. So that's why we have always 2 versions for things. Let me close this, and here you can see the R version with the example how to get the inclusion matrix. Yeah, you see the parameter is as XTS. That's the only difference between R and Python. Here, as an indicator matrix. That's it. Let's move on. I'll run that as we go. Yeah, so indeed, last webinar, as I said, some of the codes from the notebook were about getting that inclusion matrix to make things easier. And now, thanks to that function that we are actually looking at here, get tickers S&P, and the parameter in R, which is as XTS in Python, is called as price, you can get the inclusion matrix. So indeed, this notebook will be published, and you will see directly how to get the inclusion matrix. For example, in this payout, get the inclusion matrix. Here you see all the parameters that are used. Can I scroll right? Yeah. So here, as price equal true is the parameter that allows you to get the inclusion matrix. So yeah, basically you couldn't find the first notebook because we switched the notebook. We transformed it into an actual function so that it's easier for everyone. This one will be published by tonight. I'm having a question about what is the meaning of the returned data frame by the payout function, and that's good because we have one here. So let's just analyze this. So here you saw that the payout function, we called it with our data features, and it's returning a matrix. That's good. And it's returning a matrix of 107 rows by 667 columns. What is 667? Let's go back up and our portfolio here. That's better. Let's take portfolio and let's look at the number of assets within the portfolio, and 667. So I have in my payout matrix, so basically my weight matrix. So the payout just returns the weights, okay, the matrix of weights in your portfolio. You correctly have 667 columns, which correspond to what I have in my portfolio. PF is my first portfolio I've created here. Where is it? Yeah, okay. It was using the same universe. Let's switch it to the correct portfolio here. Same stuff. I've included all tickers available. 667. So you have 667 assets. So you need to decide whether to allocate to them or not. Okay. And then, so that's for the columns. Each asset on the portfolio has one column. And as per the rows, there are dates. So you could see there are dates. Okay. There are dates, and at each date you can have a cross between a ticker and a date, and you know what the weight of your ticker, so of your stock in the portfolio at that date is. So this is what you buy. I want 2% of Apple. Here I want 2% of Apple again. Here I want 2% of Apple again. What happened between 29th of February and 31st of March is that Apple, the price of Apple, the stock, has drifted. So it went up, it went down. So in your portfolio, the weight of Apple was not constant because all prices, they go around. So obviously here, even if you had 2% that day, then it's going to drift away depending on the market performance of each stock. So it's going away. Here you're saying, I am rebalancing in March here. If let's say if the price of Apple and the relative weights of Apple in your portfolio went up, and now you ended up with 2.5% one month after this rebalancing here, then if you have 2.5%, you're going to say, oh, I want 2%, so I'm going to sell the extra 50 basis points of Apple that I have in my portfolio, and you're going to do that every month for every stock that you wanted. Okay, so that's really the meaning of that matrix. Is that's my target allocation. So this is what I'm going to target, either buy or sell, to reach 2% on that day, and all the other ones, they get nothing. If there is a model associated with a strategy, do you expect the submitted files to retrain the model from scratch or to reload the model from path? That's a good question, and the best way is to have the model being able to be retrained. The reason is you might be willing in the future to retrain the model. So let's say your model is fit now, but maybe in 1 year it's not going to be fit. So we need to be able to replicate this, because your strategy is going to run into the future. It's going to be systematic, so it's going to be basically trading on new market data. So if you for us to do that, we need to be able to replicate. That's one of the point here. If we go back to the knowledge base, when you submit your model, we need to be able to reproduce it. So if there is a model that you have trained and you have pre-trained, for you obviously it's better to use the model directly from Path, because you don't want to retrain it every time you're testing your strategy. But we need to be able on our side to retrain it and to obtain the same model as you did on your personal space. For that, you need to, if there is a training, you need to either do it within the portfolio, within the payout function. So either you train it here, or what you can do is have many functions. For example, you would have here you have a def my training. My training loop. And then you will train it, okay? And then here inside the model you would call my training whenever you need it. This is quite important also to ensure that there is no data leakage, and that's why we ask you to provide us the function that allows you to train the model. We will obviously check that your model was not trained with data, for example, from 2015, and then you're investing in 2007. Doesn't make any sense. This is called forward bias, and it needs to be avoided absolutely. So this is also important for us to be able to check that. So always train the model only on the data that you have available to you. And I invite you to go on the wiki and read a bit more about that. If you go to the wiki and you look for a page called Preventing Look-Ahead Bias, this is a quite detailed explanation of what look-ahead bias is, and there are many advices that I suggest you read in order to help you see if you train a model, the model should be trained only with the blue data, never with the gray data, and when your predictions are reds. Okay, so we will check that. So we cannot trust a model that is being fed only from disk. It's not. Then we cannot verify if this has been respected. I think I have one more question, and we'll wrap it up. What is the rebalancing frequency for the equal weight benchmark at the moment here? Equal weight benchmark, because I'm using the inclusion matrix as it's returned. The inclusion matrix is returning daily inclusions. So this will be daily rebalancing. Obviously, in real life, you wouldn't daily rebalance, because otherwise transaction cost will make it very unsustainable and very costly to do so. But here, for the sake of this payout, it is daily rebalancing. So I think we'll wrap it up for today. Thank you everyone for participating. If you have follow-up questions, please do not hesitate to go on the forum or directly on the chat. We'll try to answer. It's also quite beneficial for everyone if you post the question on the forum, because it's helping others understand better also the constraints and how to do it. That's a good practice to start and use the forum. Also, please do not hesitate to answer questions on the forum, or give your view or give your opinion, because we want to favor all sharing and cooperation. So if you know the answer and the quant team from Alphien didn't have time to reply to it, please do get involved. Please put the answer out, and that'll be beneficial for everyone. Thanks again, and hope to see you next week. We'll have another webinar and pretty good. So I hope to see you there. Thanks, and have a good day. Bye.